All right, now it's time to talk about trend lines. This is going to be a way that's going to get us into cups with handles a little bit earlier than your standard pivot. At this point, everyone should be familiar with the standard pivot on a cup with handle. That's, of course, the high of the handle. As a stock goes above that high by 10 cents or more, that's your pivot. Ideally, you'd like to see a lot of volume coming in there, and that's where you would be buying it, and that's probably where you've been buying stocks for a while. That's how we do a lot of them. But occasionally, the stock will present an earlier entry, and you can use trend lines to take advantage of that. You'll get a lower cost basis. It's going to allow you to sit through some normal natural pullbacks and give you a chance to pyramid into the stock a little bit more aggressively as it goes through its standard pivot. So let's look at a couple of examples. Our first one is Fairchild Camera. Now this is back in 1958, so it's a ways back, but there's a lot to learn, and we study a lot of stocks going back from the beginning of the last century all the way through to current stocks. So looking at Fairchild, you'll notice it's a little thin, but that's how things were back in the 50s. It's a really deep cup, as you can see on the left side high. It was a little violent as it was coming down. You had a very nice shakeout on the bottom as it went down to 2150. It starts building the right-hand side. It gives a little bit of a handle type feel down there in the low 27s, but that handle is just a little bit too low in the structure to be buying it. So then it moves up, and you got a powerful move up to 32.75, and then you want the stock to start backing off and just kind of settling down for a little bit. And as it does that, it's forming some areas of resistance. Sometimes they're horizontal areas where you can just draw a straight line. Other times it's a clear downtrend, and that's what we have here. As you can see, that line that you'd start at the 32.75 and draw it and just make a tangent with that little peak there. We're waiting to see if that stock can penetrate that. That's going to be your early entry, versus our standard pivot would be just waiting for the stock to get through the 32.75. So as you can see, about a week before it goes through that alternative pivot or that trend line buy point, you can see a very nice upside reversal where it shakes out almost underneath the prior low of the handle and goes up, closing near the highs, and then 2 days later you've got a tiny little spread closing at the highs. Great action. It's what you'd like to see, but it's too early to be buying that stock because it hasn't gone through an area of resistance. You want that clear area of resistance so the stock can just kind of rocket higher. And we have that. Right as it starts penetrating through that downtrend line, you can start buying it, and notice that volume actually picks up. We like to see high volume when a stock breaks out of a pivot. That's showing a ton of demand. Now, some of these alternative pivots that we're going to be talking about aren't as obvious, so there's not going to be as much volume as you typically see because not everyone sees it. Again, you are getting in ahead of most people, and most people would see it as the stock goes into all-time new highs at 34.63 on the left side of the chart, or that high of the handle, the 32.75. So we're getting in there before most people see it, before it's very obvious. So that's a beautiful alternative pivot going through that trend line right there. And the volume is much higher than average. You could be buying the stock there. Notice the huge advantage that you have. At this point, you can sit with that stock as it goes through our 32.75 on that nice little gap up on that huge spread. With even larger increase in volume, you can be hitting that stock hard, buying more shares. You're still going to have a relatively low cost basis at that point. And you had a huge jump start versus just waiting for it to go through 32.75. So that was our first example, and that was Fairchild Camera. This went on to have an enormous move back in the late 50s. All right, let's go over our next one. This was Corvette. This broke out in October of 61, and this had already had a big move prior to this cup with handle that it formed. And you can see over on that left side high, it really gave you a sense of almost a climax top, or definitely climax action. And most people would think the stock is done, and it's not our job to really guess what's going to happen. You just sit back and observe and see the stock build its base. And as it makes its way down to the 47.50, you can see the 3 waves down that it forms. Is something very typical we see in a lot of charts. So that's nice action, but it's not giving us a reason to buy it. It starts moving up the right side all the way up to 63, and you can see that clear area of resistance that it hits right there. Based on the action, that wide spread on that day that it hits 63, backs off, and the stock is going to put in some time. And it does. It moves down to 56, very orderly. That's typical action. And it goes up through that 63. You could be buying it right there. That's a legitimate buy. The volume isn't exactly what you'd like to see, but that was going through what we'd call a standard pivot of the high of the handle. So let's say you bought it there, and it just kind of goes back and forth, chopping around for a few weeks, and then goes through another high. And you really think it's off to the races, but it just runs into a wall and then backs away. By the time that it falls down to 60 and a quarter, you're probably worn out of that stock. I know I would have been out probably before then. It's just not going anywhere. But you don't take it off your radar. You keep watching the stock, and you want to see, is it going to set up and give you a better entry point? That happens all the time with stocks. So as it's coming down, the chart pattern is now actually better because it has a really nice shakeout. It's gone below that prior floor of the 61.50, and then it goes even below that 60 and a quarter. So you're just taking out areas where the stock should be getting support. You're shaking out a lot of weak holders. Anyone who has been buying the stock over the last month is probably worn out of the stock. That's great. The people that are left, they don't want to give up their shares. That's what you want to see in a stock. You want to see people holding on to their shares. They're keeping them dear. So as the stock starts running up, they're not willing to just dump their shares into an advance. That's very, very important. Remember, this is all supply and demand. So you want that supply really constricted, people holding on to those shares. All right, so after it hits bottom there a few days before that pivot, you're not buying it, you're just watching it, and you can see that well-defined trend line starting up at the 66.38. Draw a little line down there. Right at the peak there on that blue day, that's an area of resistance. You can even draw a horizontal line over the day about a week before that. Many times when you're looking at a chart, you'll see different areas of resistance. They'll normally be about at the same place, and many times the stock will move through that area of resistance, multiple areas of resistance on the same day. As a stock forms a handle, many times you'll see lots of different areas of resistance that are formed. Sometimes it'll be a downtrend line. Sometimes it'll be a horizontal area where it just hits a level and backs away. This one has both. You have a clear downtrend line that you can draw, as we have there, starting at the 66.38. Or you can have a little horizontal area where it kind of ran into resistance right there and it backed away and then it had a shakeout. And as it moves up on that third day off the bottom, it goes through both of those areas on the same day. This is very typical, it's very normal, and we see that in a lot of our models. And the nice action on that day is you're closing up near the highs, you've got a big spread, and notice that volume, that's swelling. It's higher than any volume that we've seen going back for a month or so. So this is great action, and you could be buying that. You could have your full position on that day or almost your full position. And notice what happens the next day. You have this nice breakaway gap. That is an enormous move, and it didn't give you a chance to get in at that 66.38. This is why it's critical to be looking for alternative pivots, whether it's the downtrend line or a prior area of resistance. It's getting you in early, and many times you'll see this breakaway gap that happens, and you'll already have a position. Then the question is just, do you add more on that gap up day? I typically would. But some of you might just want to hold on to your position, at least while you're just kind of getting used to trading this way. And then over time, with some experience, when you have a breakaway gap, you definitely want to be adding to that, because it's one of those powerful things that will happen at the beginning of a move. The odds are in your favor, and it's worth stepping up to the plate. So that was Corvette back in 1961. All right, now let's get into our next example. This is Green Mountain Coffee back in 07. This is something that I'm sure most people listening have traded. If you haven't traded it, I'm sure you probably have one of their coffee makers at home. I know I do. So this was a powerful move. Many times it was really, really volatile and hard to trade, but this is a great example of a cup with handle that offered a lot of things to learn. So let's go over what was happening here. So first of all, you had a big run up from the 40s all the way up to the 60s, and it starts forming this cup with handle, a very classic looking cup with handle. A lot of devastation on the left side. You don't prefer to see that big down day where it came down to the 50-day. But when a stock acts like that, you want to see how does it handle itself afterwards. And that was very ideal what happened after that terrible day, it got really nice support right at the 50-day, showing you that the institutions were willing to step up and support the stock after it had been hurt so bad. So it starts rounding out and making the right side of the cup. You don't want it to go straight up. That would look more V-shaped. So this is really nice looking U-shaped pattern. Goes up, runs into an area of resistance at 64.80. Very normal. It's better that it stopped there rather than going straight into new high ground. Backs away. Notice those days of support. We've got 3 days in there as it's coming down, where each day you're closing almost at the peak. Very, very nice action. It's a sign of support. You can see in there, you can draw a little downtrend starting at that 64.80, touching some of those days there. And as it penetrates, you could be buying that stock. In fact, I probably would be buying that stock there. Now, we see what happens afterwards. Moves up 2 days later, going through the 64.80, which is your standard pivot. And of course, we always like to add 10 cents on to that. So at 64.90, you'd be buying it. And it doesn't really go anywhere. So it just goes back and forth. At this point, you might give it some room, or you might be a little quick on the trigger just because the stock has already had a big advance and sell some or all of your shares. But eventually, within the next week or so, it's starting to roll over. You don't know what's going to happen, so you're going to be backing away, and that's what I would be doing at that point. Now, some people are going to just say, you know what, I'm going to buy the stock, and until it's down 8%, I'm not going to sell it. There's not really a right or a wrong answer. It really just depends on how quick you want to cut your losses. So as you're going through this, just imagine, what would you be doing on each one of those days? Pretend like it's at the low of the day and the whole market is coming in. What would you do? And be honest with yourself and just learn as you're going through here. And that's what we like to do when we're looking at charts. Picture yourself in the moment and how would you handle it. And the important thing is to just find a method that really works for you and just be consistent with that. So I know I'd be selling it in there, but be willing to buy it back. And as it goes up through this other area of resistance that we started off at the $66 area, it goes through that nice downtrend. And look at that volume pickup as it moves up. Again, a very nice spread, closing in the upper part of the range. It does penetrate through your standard pivot at $66 plus our 10 cents that we need. So it all happens on the same day. That's really nice action. And you're in there for that next gap up. And of course, this launched into another big part of Green Mountain's move. All right, so that was Green Mountain Coffee, or as most of us know it as GMCR, back in May of 2007. All right, the last one we're going to go over with these trend lines is a really special one. This is Qualcomm back in 1999. Now, I'd advise not spending a ton of time researching the patterns back in 1999. It was a wild and crazy time. Anyone who traded back then just wishes it was 99 all over again. But it's not. And many of the charts were very wide and loose, but still ended up working. But this one is such a special stock. This was one of the most powerful plays during that move as far as an institutional quality name. And this is before a 2,000 plus move, this cup with handle that we're going to go over here. And Bill was buying the stock, the firm was buying the stock, and made a ton of money off of it. So let's just go over and examine the best way to enter Qualcomm at the very beginning of this massive move that it had. Now, first of all, you'll notice that this stock was doing nothing for a long period of time. It was just building base after base that didn't work out. That's normal, not ideal. We prefer to see stocks that are, just forming nice uptrends and then build another base. But sometimes the stock is just dead for a while. Things change, the story changes, and you've got to be on top of that. So this forms a very deep cup with handle that almost has a double bottom type feel where you hit one bottom, you run up to 52.63, and then you back off. Very violent. And that's what the time frame was. Most people remember 99 as just going straight up. But if you go back and study the charts, it wasn't going straight up. There were lots of wiggles and wobbles. And that's what we're creating, these kind of wide and loose type of patterns that you have. But as it formed that second bottom within this cup with handle, you had a nice shakeout below the first one. Then at that point, you start moving up the right side. Lots of powerful days. Look at all those blue days where you're closing near the peaks. That is what you'd prefer to see. You don't want to see a lot of them stalling. We have a few stalling. No chart is perfect, but the vast majority of these are big days closing near the peaks. So it hits $60. Sometimes they'll stop at round numbers, especially at $100, $150, $200. That's very normal. So it's a psychological thing. Hits $60, just can't get through there, starts backing away. Again, you can notice many waves down. After 2 days, that was kind of your first wave down. Then you kind of move up a little bit, you have another wave down. Finally, your last wave down, bottoming at $49. So a huge shakeout. And many people would write this stock off. The relative strength line was kind of lagging based on the history that we already talked about, but there was something new and unique that was going on here, and it ended up translating into a very powerful move. So you can wait for the standard pivot at $60. There's nothing wrong with that. You just wait for the stock to penetrate above that by 10 cents and buy it, and you make an enormous amount of money. But here's one that you're going to want a pyramid. At least that's what we know at this point. Studying in time, this was an enormous run, and the firm pyramided into the stock, eventually selling it into a climax top when the stock was over. So you want to have a low cost basis to allow yourself to be able to do that. This gives you a great opportunity to get into the low $53 range versus $60. So how do we do that? Again, we just draw that nice downtrend line starting at $60. Just make it tangent with the peaks there. Sometimes it doesn't line up exactly right, and this is where the art kind of comes in. Rather than making it tangent with the 58.38, I'd make it tangent with that other peak, the peak right there. And that happens a lot. There's not an exact way to do this. Over time, the more of these you study, you're going to be able to draw your lines a little bit better. So as it goes through there, you can notice that big spread, the volume coming in. The volume had really dried up along the low $50 range. You have the little gap up, big spread closing near the highs. You're jumping on that stock. You're buying it. You've got your full position within that day or the next day. Then as it goes through $60, then it's giving you another opportunity. You can sit back and just hold on to that position with your low-cost basis stock or decide to buy some more of it. Those are the opportunities you want. Notice the difference. $60.10 to start buying it, or $53.20. So look at the opportunity that we have. We can either wait for the stock to go through $60.10 and start buying it, or we can buy it in the mid $53 range and have your full position probably by $54, $55. That is ideal. That's the way you want to handle what ended up being just a monster run. And that was Qualcomm back in 1999. I suggest you go and really study this chart, what happened afterwards. Someday we'll see a move like that again, and you want to have done your work, learned ahead of time how to get in there as early as possible.